Trading is not just about buying low and selling high. It is about timing, discipline, and understanding human behavior reflected in price movements. In the world of stock trading, some people rise above the noise and master the rhythm of the market. They are called momentum traders. These are the traders who know how to catch a trend early, ride it with conviction, and exit before the storm hits. In Momentum Masters, 3 legendary traders, Mark Minervini, David Ryan, and Dan Zanger, open the doors to their trading mindset. Each of them has turned small sums of money into fortunes, not by luck, but through precise execution and mental strength. Their experiences teach us that success in the stock market is not a gift. It is a skill built through discipline, patience, and a deep respect for risk. This book is not a collection of theories. It is a journey through real stories, failures, recoveries, and victories. It shows how ordinary people became extraordinary traders. It explains how they think, how they select stocks, how they control emotions, and how they manage risk when everything seems uncertain. Momentum trading is like surfing. You cannot control the wave, but you can learn how to read it. You can sense when it is about to form, when it gains power, and when it starts to break. The masters featured in this book learned that success comes from waiting for the perfect wave, the perfect setup, and then riding it with full commitment. As you listen to their journeys, you will notice one thing in common. Every great trader begins as a beginner. They all faced failure, frustration, and doubt, but they learned from their mistakes, refined their strategy, and developed the mindset of a winner. This is not a story of quick riches. It is a story of transformation, from confusion to clarity, from fear to confidence, from randomness to rhythm. In the chapters ahead, we will walk beside these traders, step by step, as they reveal how they started, what they struggled with, and how they finally discovered their edge. We will explore how they select winning stocks, time their entries, and protect their capital. We will also dive deep into the psychological game, the part of trading that separates amateurs from champions. By the end of this journey, you will understand not only how to trade momentum, but also how to think like a momentum master. Now let us begin with their beginnings. Let us step into their world and discover how they got started. Part 1. The Traders and Their Journey. Every master was once a beginner. Every legend started with uncertainty, fear, and mistakes. The story of Mark Minervini, David Ryan, and Dan Zanger is no different. Before they became icons of momentum trading, they were ordinary people chasing an extraordinary dream, the dream of financial freedom through the market. Part 1 takes us back to where it all began. It shows the early struggles, the painful losses, and the defining moments that shaped their trading philosophies. Each of these traders followed a different path, yet their destination was the same: mastery. They faced setbacks that would have broken most people, but instead of giving up, they learned, adapted, and kept moving forward. This part reveals the truth that no one becomes successful overnight. The market tests everyone. It humbles those who are arrogant and rewards those who are disciplined. Minervini learned the power of rules and structure after losing his savings. Ryan, trained under the legendary William O'Neill, discovered how preparation and research can separate winners from losers. Zanger, once a construction worker, turned a few $1,000s into millions by mastering price patterns and timing. Their journeys remind us that success is not about predicting the future. It is about surviving long enough to learn from the past. It is about developing patience when others panic and confidence when others doubt. As we step into their early years, we begin to see how small sparks of curiosity turn into flames of passion. We see how one trade can change a life, and how one moment of realization can redefine destiny. Every great trader has an origin story, a point where everything began to shift. That is where our story begins too. Now let us move forward and discover how they got started. Chapter 1. How they got started. Every trader begins somewhere. For Mark Minervini, David Ryan, and Dan Zanger, the path to trading success did not start with wealth or privilege. It started with curiosity, ambition, and the hunger to change their lives. They were not born as market wizards. They became that way through years of persistence, trial, and error. Mark Minervini's journey began in a small apartment with no formal training in finance. He was fascinated by the idea that the stock market could offer unlimited opportunity to anyone who learned its language. But like many beginners, he made the same mistakes every newcomer makes. He chased tips, ignored risk, and held on to losing trades for too long. Those early failures were painful, but they became the foundation for his future success. He realized that trading was not gambling. It was a skill that could be mastered through study, discipline, and consistency. David Ryan's story is a bit different. He was drawn to the market in his teenage years. While others were reading comics, he was studying price charts and annual reports. Ryan's real breakthrough came when he met William O'Neill, the creator of the Can Slim method and founder of Investors Business Daily. Under O'Neill's mentorship, Ryan learned that great stocks share common traits before they make big moves: strong earnings, leadership in their sector, and rising institutional demand. He understood that success in the market comes from identifying strength early and holding it through the trend. Dan Zanger, on the other hand, came from a world far from Wall Street. He was a pool contractor with a dream to break free from a life of physical labor. His passion for chart reading became an obsession. He would spend hours analyzing stock patterns, memorizing setups, and practicing entries on paper. In the late 1990s, during the internet boom, his preparation met opportunity. With only $10,000, he turned it into over $40 million in less than 2 years, one of the greatest trading runs ever recorded. But his story was not about luck. It was about years of groundwork, patience, and absolute belief in his method. Each of these traders began with uncertainty, but they all shared one trait: obsession. They studied charts the way a scientist studies data. They tracked their trades, recorded their mistakes, and refined their process. When others treated trading as a hobby, they treated it as a craft. Their early days were not glamorous. There were long nights, losses, and self-doubt. But every failure became a lesson. Every mistake revealed a new insight. Minervini learned to focus on risk before reward. Ryan learned the power of studying market leaders. Zanger learned that chart patterns were the footprints of money. By the end of their beginnings, something profound had changed. They were no longer casual players in the market. They had transformed into disciplined students of price action. They started seeing what most traders never see: the rhythm beneath the market's chaos. This first chapter reminds us that everyone starts small. You do not need a finance degree or millions in capital to succeed. What you need is commitment, curiosity, and the willingness to keep learning even after failure. As their stories unfold, one thing becomes clear. The market rewards those who respect it. It punishes those who underestimate it. And for these three men, every early loss became a stepping stone toward mastery. Their beginnings set the tone for everything that follows: the struggles, the breakthroughs, and the creation of their signature momentum edge. Now, as we turn the page, we move from beginnings to battles. Let us see how these traders faced their toughest tests and found turning points that shaped their destiny. Let us step into the next chapter. Chapter 2: Early Struggles and Turning Points. No journey to success is without obstacles. For Mark Minervini, David Ryan, and Dan Zanger, the path was filled with challenges that tested their patience, discipline, and commitment. These early struggles were not failures to be ashamed of. Instead, they became the crucibles in which their trading skills were forged. Mark Minervini's early career was marked by frustration. He experienced significant losses that shook his confidence. At times, he wondered if he was cut out for trading. His turning point came when he realized that luck could not be relied upon. He needed a method, a precise, disciplined approach that would guide every decision. Minervini began to study the patterns of winning stocks, focusing on price action, volume, and market leaders. He learned to respect risk, using strict rules for stop losses and position sizing. This discipline allowed him to recover from early setbacks and gradually build consistent profits. His struggle taught him the importance of structure, patience, and having a clear edge in the market. David Ryan faced his own battles. Early on, he struggled with timing and confidence. Even after studying under William O'Neill, he made mistakes. He bought stocks too early, exited too late, and sometimes let emotions dictate his actions. The turning point for Ryan came when he began to focus not just on good stocks, but on stocks that were leaders in strong sectors. He learned that the market often rewards strength and punishes weakness. By aligning himself with market leaders and respecting momentum, Ryan began to see consistent gains. He also realized that preparation was essential. Spending hours analyzing charts, trends, and earnings reports gave him an edge that most traders lacked. Dan Zanger's early struggles were both financial and psychological. As a pool contractor, he had little capital to risk. When he started trading, each loss felt magnified. He also struggled with self-doubt and fear, wondering if he could ever compete with professional traders. His turning point came with the internet boom of the late 1990s. Zanger had prepared for years, learning to read charts and memorize patterns. When opportunity arrived, he executed his strategies with precision, turning a small account into millions. His early struggles taught him that preparation meets opportunity only if discipline and patience are in place. Across all three traders, one lesson is clear: early setbacks are inevitable. They are part of the process. What separates champions from amateurs is not the absence of losses, but how one reacts to them. Minervini, Ryan, and Zanger all developed systems to learn from mistakes instead of repeating them. They kept journals, recorded trades, and analyzed outcomes to improve continuously. They discovered that trading is as much about mental toughness as it is about market knowledge. These turning points also emphasize the importance of finding an edge. It is not enough to follow tips or rely on luck. Success requires understanding what makes a stock move, knowing how to enter at the right time, and having rules to manage risk. Each trader developed their own signature strategies, but all shared common principles: discipline, patience, preparation, and respect for the market. By the end of this phase, they were no longer beginners chasing quick gains. They had begun to understand the rhythm of the market. They had faced fear, loss, and doubt, and emerged stronger. The struggles had taught them resilience, the turning points had given them clarity, and the lessons would guide every trade moving forward. These early experiences set the stage for the next step in their journey, discovering the strategies and methods that would define them as momentum masters. Now we move into the next chapter. Chapter 3: Finding a Winning Strategy. After experiencing early struggles and important turning points, Mark Minervini, David Ryan, and Dan Zanger all realized that talent alone was not enough. Success in trading comes from having a method, a repeatable system that consistently identifies opportunities while managing risk. This chapter explores how each trader discovered their winning strategy, the one that would ultimately define their careers. Mark Minervini's approach evolved from trial and error. He studied thousands of stocks, tracking patterns, volume shifts, and price behavior. He realized that stocks do not move randomly. Leaders emerge from strong fundamentals and clear technical signals. Minervini developed the 70% rule, a concept that focused on stocks showing extreme relative strength. His system emphasized precise entry points, strict stop losses, and scaling out of positions to maximize gains while protecting capital. By following this structured approach, Minervini transformed from a trader who experienced sporadic wins and painful losses to one who could consistently outperform the market. His strategy was not complicated. It was disciplined, measurable, and repeatable. David Ryan found his winning strategy by combining mentorship with observation. Working under William O'Neill, Ryan learned to identify stocks in strong uptrends and sectors exhibiting leadership. He refined his method to spot early breakouts and price patterns that indicated institutional buying. Ryan also emphasized preparation and record keeping, studying charts daily, noting entry and exit points, and continuously analyzing the results of his trades. Over time, this process became second nature. He could quickly identify promising setups, make informed decisions, and manage risk with confidence. Ryan's success was rooted in marrying technical skill with careful analysis, ensuring that every trade had a rational basis. Dan Zanger's strategy was born from obsession and pattern recognition. Spending countless hours studying charts, He memorized setups that historically preceded big moves. Zanger relied heavily on volume spikes and specific price action patterns, knowing that they often signaled the beginning of a momentum surge. His approach was highly disciplined. He would never force a trade or deviate from his plan. Each trade was executed with precision, and each position had a predetermined exit point. Zanger's strategy was simple in principle, but required absolute mental focus and preparation. It allowed him to turn a modest account into millions in a short span while maintaining control over risk. Across all three traders, a common theme emerges. A winning strategy is not about guessing the market. It is about identifying what works and sticking to it. They all emphasize the importance of preparation, observation, and disciplined execution. They also recognize that no strategy works all the time. Losses are inevitable, but a well-designed method ensures that wins outweigh losses over the long term. Developing a winning strategy also involves knowing yourself. Each trader tailored their approach to their personality, strengths, and risk tolerance. Minervini thrives on structured rules and defined setups. Ryan relies on careful study and adherence to proven patterns. Zanger depends on intuition, honed through years of chart analysis. The key is alignment. Your strategy must suit your style and mindset to be sustainable. This chapter demonstrates that mastery is not inherited. It is cultivated through study, patience, and continuous refinement. A winning strategy gives traders confidence to act decisively, manage risk, and stay consistent even when the market is volatile. As we move forward, the next chapter will show how these traders defined the very concept of a momentum edge, the special advantage that allowed them to outperform the market repeatedly and consistently. Chapter 4. Defining the momentum edge. By the time Mark Minervini, David Ryan, and Dan Zanger had found their strategies, a new realization became clear. Success in trading is not just about having rules or methods. It is about having an edge, a distinct advantage that allows you to act with confidence when others hesitate. This edge is what separates ordinary traders from true momentum masters. Mark Minervini defines momentum as the combination of strong fundamentals and precise technical setups. He realized that the stocks most likely to surge are not just good companies. They are leaders showing exceptional price performance relative to the market. This is what he calls relative strength. Minervini's edge lies in identifying these leaders early, entering at the optimal point of the pattern, and managing risk rigorously. His approach ensures that the odds are always in his favor, and that small mistakes do not turn into catastrophic losses. The momentum edge is not about predicting the future. It is about stacking probabilities in your favor and letting the market reveal the path. David Ryan's momentum edge comes from aligning with strength in the market. He learned that winning trades are often clustered in leading sectors and strong stocks. By observing sector rotation, institutional buying, and breakout patterns, Ryan developed the ability to spot stocks with the highest probability of moving sharply. His edge is further reinforced by preparation, studying charts, keeping trade journals, and maintaining discipline in timing entries and exits. For Ryan, momentum is about riding the wave of strength while respecting market realities, never forcing trades, and always following the signals. Dan Zanger's edge is built on pattern recognition and timing. He spent years memorizing chart setups, understanding how price and volume interact to signal explosive moves. Zanger's edge lies in his ability to see potential breakouts before the crowd. By combining rigorous chart study with strict risk management, he could enter trades at moments when upside potential was maximized and downside was controlled. Zanger treats momentum as a visual language, reading the market like a story unfolding in real time. His edge comes from preparation, observation, and decisive execution. All three traders share some fundamental principles about momentum edges. First, momentum is about leadership, the strongest stocks in the strongest sectors. Second, timing is crucial. Entering too early or too late reduces the advantage. Third, risk management cannot be ignored. Even a perfect setup can fail if stops are not properly placed. Fourth, discipline and patience are key. The market rewards those who wait for high-probability setups rather than chasing every opportunity. The momentum edge is not a formula to be copied blindly. It is a mindset, a combination of preparation, observation, and execution that allows traders to see opportunities others miss. It is also a personal advantage, tailored to the trader's skills, risk tolerance, and personality. Each of these masters discovered their edge through years of learning, mistakes, and refinement. Understanding your edge allows you to trade with confidence, knowing that every decision is based on probability, not guesswork. It creates clarity amid chaos, enabling traders to act decisively and consistently. Momentum trading is not about being right all the time. It is about being right often enough and managing losses effectively to stay in the game. As we conclude this part of the journey, it is clear that identifying and defining a momentum edge is the foundation of all successful trading. It sets the stage for the next phase, understanding the core principles that guide every trade. Next, we move into Part 2, the core principles of trading, and explore how stock selection, chart patterns, timing, and risk management work together to create consistent results. Part 2, the core principles of trading. Finding a winning strategy and defining a momentum edge are only the beginning. Mastery in trading comes from understanding the core principles that guide every decision, every entry, and every exit. Part 2 dives into these principles, revealing the practical tools and techniques that separate casual traders from true momentum masters. In this section, we explore how Mark Minervini, David Ryan, and Dan Zanger consistently identify high-probability trades. You will learn how they select stocks, read charts, time their entries, and manage risk. Every principle is rooted in experience, lessons learned from thousands of trades, both wins and losses. These principles are not theoretical. They are actionable, repeatable, and designed to give traders an edge in any market environment. This part also emphasizes that trading is not random. The market may appear chaotic, but patterns exist. Leaders emerge. Trends develop. By studying these signals carefully, a trader can position themselves for maximum advantage while protecting capital. Core principles are the bridge between knowing a strategy and executing it successfully. They create discipline, clarity, and confidence in the trader's decisions. As we move forward, we begin with the most critical step in trading, selecting the right stocks. The ability to choose the right candidates for momentum trades is the foundation upon which everything else is built. Chapter 5: Stock Selection and Screening. One of the most important skills a momentum trader can develop is the ability to identify the right stocks. Mark Minervini, David Ryan, and Dan Zanger all emphasize that trading is not about watching every stock in the market. It is about focusing on the ones with the highest probability of moving sharply. Stock selection is the foundation of successful trading because no strategy or edge can overcome poor choices. Mark Minervini looks for stocks that show strong relative strength, meaning they are outperforming the overall market and their peers. He studies patterns of leadership, searching for companies with accelerating earnings, rising sales, and positive news flow. A stock can be technically perfect, but if its fundamentals are weak, it often fails to sustain a move. Minervini combines these elements to create a watch list of candidates that have both technical and fundamental momentum. David Ryan follows a similar philosophy, often focusing on sector leaders. He observes which industries are strong in the current market cycle and identifies the best performing stocks within those sectors. Ryan emphasizes that strength begets strength. Stocks that are leading today are more likely to continue leading tomorrow. He screens for price patterns, volume trends, and institutional interest. By concentrating on a smaller pool of high-probability stocks, Ryan increases his chances of catching significant moves while avoiding distractions. Dan Zanger takes an even more technical approach. He spends hours memorizing chart patterns and screening for setups that historically precede explosive gains. Zanger pays close attention to volume, breakouts, and consolidation patterns. His selection process is rigorous. A stock must meet very specific criteria before it qualifies for a trade. This disciplined filtering allows him to focus only on the highest potential opportunities, reducing wasted effort and emotional stress from chasing weak setups. All three traders stress that stock selection is more than a mechanical process. It requires observation, judgment, and experience. Even after screening, they wait for confirmation in price action before committing capital. Screening tools, watch lists, and filters are helpful, but they cannot replace intuition developed through careful study and repetition. A critical point in stock selection is avoiding weak stocks. Many traders waste time chasing laggards or hoping for reversals that rarely happen. Momentum masters understand that the market rewards strength and punishes weakness. They seek stocks that are already in motion and positioned to accelerate. This mindset saves capital and energy and ensures that traders are aligned with the forces driving the market. Positioning is also tied to risk. Selecting the right stock is only half the battle. Traders must determine where to enter, how much to invest, and how to protect against losses. Screening helps narrow choices, but preparation ensures execution is precise. These steps create a framework that combines probability with discipline, forming the basis for consistent success. In short, stock selection and screening are the first filters in the journey of every momentum trade. They separate promising opportunities from distractions, clarify focus, and set the stage for precise entries. With the right candidates in sight, a trader can move on to the next critical principle: reading charts and understanding price action. Chapter 6: Chart Patterns and Price Action. Once the right stocks are selected, the next step is understanding how they move. Mark Minervini, David Ryan, and Dan Zanger all agree that charts tell the story of the market in real time. Price action reveals strength, weakness, and potential turning points. Learning to read these signals is essential for momentum trading because even the strongest stock can fail if entered at the wrong moment. Mark Minervini focuses on precise setups, often looking for consolidation patterns followed by breakouts. He studies base formations, cup with handle patterns, and other technical structures that indicate accumulation before a surge. For him, price patterns are not just shapes on a chart. They reflect the psychology of buyers and sellers. A stock forming a tight base is showing control, with buyers outweighing sellers, preparing for a move higher. Recognizing these setups early gives a trader a chance to enter before the broader market notices the momentum. David Ryan emphasizes trend confirmation. He observes the slope of a stock's price over weeks and months, watching for acceleration. Volume plays a critical role. A breakout accompanied by high-volume signals, commitment from institutions, and smart money. Ryan also tracks relative strength, comparing the stock to market indices and sector peers. A strong chart confirms the stock's leadership and potential for further gains. By analyzing price action, Ryan can differentiate between temporary spikes and genuine momentum moves, allowing him to focus on high-probability trades. Dan Zanger's approach is highly pattern-driven. He memorized chart setups that historically led to explosive gains, from triangles and wedges to flag formations and breakouts from tight consolidations. Zanger also studies micro-patterns within daily charts to fine-tune entry points. He treats charts as a visual language. Each candlestick and volume spike communicates the intentions of market participants. This level of observation allows him to anticipate moves before they fully unfold, giving him an edge over less attentive traders. All three traders stress that price action is dynamic. Charts are not static diagrams, but reflections of ongoing supply and demand battles. A pattern that works in one environment may fail in another, which is why context, including market trend, sector strength, and momentum, is crucial. Chart patterns alone are insufficient. They must be interpreted in alignment with market conditions. Another important principle is patience. Waiting for the pattern to complete reduces risk. Entering too early or ignoring signals can lead to premature losses. Momentum traders know that every chart pattern has an optimal entry zone. They wait for confirmation, a breakout, a volume surge, or a supportive technical signal before committing capital. Risk is embedded in price action as well. Candlestick formations, support and resistance levels, and moving averages all provide clues for where to place stops and exits. A disciplined approach to reading charts ensures that potential gains are maximized while losses are controlled. Ultimately, mastering chart patterns and price action is about seeing the market as it is, not as we wish it to be. It combines observation, analysis, and discipline, giving traders the confidence to act decisively. With these skills, momentum traders can identify setups with high probability and manage their trades efficiently. With stock selection, screening, and chart reading in place, the next step becomes crucial, knowing exactly when to enter. Timing can be the difference between a profitable trade and a missed opportunity. Chapter 7: Timing and Entry Techniques. Even after selecting strong stocks and analyzing chart patterns, a trader's success ultimately depends on timing. Entering too early can lead to unnecessary losses, and entering too late may reduce potential gains. Mark Minervini, David Ryan, and Dan Zanger all emphasize that mastering timing is as critical as choosing the right stock. Precision in entry allows traders to capitalize on momentum while limiting risk. Mark Minervini relies on defined setups to determine the exact point of entry. He looks for price consolidation, breakouts from tight bases, and other high-probability patterns that signal the beginning of a strong upward move. His strategy emphasizes entering after confirmation rather than anticipating the move prematurely. This disciplined approach reduces the likelihood of false signals. Minervini also scales into positions, entering partially and adding more as the stock confirms strength. By doing this, he balances the potential for reward with protection against risk. David Ryan focuses on aligning his entries with the broader market trend. He observes sector strength, institutional buying, and relative performance to identify optimal timing. Ryan uses breakout points as signals for entry, but he also monitors pullbacks to ensure the stock is not overextended. This approach allows him to enter trades with momentum already established, while minimizing exposure to sudden reversals. He emphasizes that timing is not about guessing. It is about waiting for the market to confirm the setup and then acting decisively. Dan Zanger takes timing to a highly precise level, using both pattern recognition and intraday signals. He studies volume surges, breakout candlesticks, and consolidation breakpoints to determine the best moment to commit capital. For Zanger, the edge comes from being prepared to act instantly when the pattern completes. He also uses stops and predefined risk levels to protect his capital in case the trade fails. His discipline ensures that he does not overtrade or chase the market impulsively. All three traders agree that entry techniques are closely tied to risk management. Knowing where to place a stop loss, how much capital to allocate, and when to scale into a position is as important as identifying the trade itself. Timing is about precision, not speed. It is about choosing the right moment when the odds are in your favor, not reacting to emotion or fear. Another principle in timing is patience. Momentum traders understand that the best trades do not happen every day. Waiting for the perfect setup often means sitting on the sidelines while the market moves around. However, this patience pays off because it ensures that every entry has a clear probability of success. Entering impulsively without confirmation often leads to losses and frustration. Finally, timing is a combination of preparation, observation, and decisiveness. Minervini, Ryan, and Zanger all stress that preparation is ongoing. Studying charts, tracking leaders, and noting potential setups in advance allows them to enter trades the moment conditions are favorable. Observation ensures that they are aligned with market strength, and decisiveness allows them to act when the opportunity appears. With timing and entry techniques mastered, a trader can position themselves to capture maximum gains. But no strategy is complete without proper risk management. Even the best setup can fail, and losses are inevitable. Understanding how to protect capital is what separates consistent winners from occasional lucky traders. Chapter 8: Risk Management and Position Sizing. Even the most skilled trader cannot avoid losses entirely. What separates champions from amateurs is how they manage those losses and protect their capital. Mark Minervini, David Ryan, and Dan Zanger all agree that risk management is the foundation of consistent trading success. Without it, even a perfect strategy can fail. Mark Minervini approaches risk with strict rules. Every trade has a predetermined stop-loss level, defined before any capital is committed. He calculates the maximum amount he is willing to lose on a trade, ensuring that a single failure will not threaten his overall account. Position sizing is also critical for him. He adjusts the number of shares based on volatility and confidence in the setup. A higher probability trade may warrant a larger position, but never beyond what his risk tolerance allows. By combining stops and calculated position size, Minervini protects his capital while remaining flexible to exploit opportunities. David Ryan emphasizes proportional risk. He determines how much of his portfolio can be exposed to a single trade and how to allocate capital across multiple positions. Ryan also stresses that no trade is worth emotional instability. By limiting losses to a small percentage of the total account, he ensures that one mistake does not spiral into disaster. Risk management is not just a technique for preserving money, it is a tool for preserving confidence. Knowing that the downside is contained allows a trader to act decisively and stick to their plan. Dan Zanger treats risk as a combination of technical analysis and preparation. His stop losses are usually placed at key support levels or below significant price points, ensuring that a break of the pattern signals a controlled exit. He also scales positions to control exposure and reduce stress. Zanger understands that discipline is more important than intuition when managing risk. Even a strong pattern can fail, and his structured approach ensures that losses remain small while letting winners run. All three traders share several core principles about risk. First, never risk more than you can afford to lose. Second, position size should be proportional to the trade's probability and volatility. Third, always define your exit before entering the trade. Risk is not something to react to. It is something to plan for and control. Risk management is also psychological. Traders who ignore it often allow fear or greed to dictate their decisions. A well-defined plan, however, removes emotion from the equation. It creates clarity and confidence, allowing traders to focus on executing their strategy rather than worrying about potential losses. This mindset is critical for momentum trading, where rapid price movements can trigger emotional reactions. Position sizing further complements risk management. By adjusting the size of each trade based on risk and probability, traders can survive losing streaks without depleting capital. Minervini, Ryan, and Zanger all emphasize that surviving the market is the first rule of trading. A profitable trade today is useless if you are unable to trade tomorrow, because your account was wiped out by poor risk management. Ultimately, risk management and position sizing turn uncertainty into a manageable equation. They allow traders to act with confidence, knowing that losses are contained and potential gains are maximized. By combining preparation, discipline, and controlled exposure, momentum traders can navigate volatile markets while protecting the foundation of their trading journey, their capital. With risk under control, the next step is understanding when and how to exit trades. Capturing profits while preserving gains is essential for long-term success. Chapter 9. Selling Rules and Taking Profits. Knowing when to exit a trade is just as important as knowing when to enter. Mark Minervini, David Ryan, and Dan Zanger all emphasize that successful trading is not about being right all the time, but about capturing gains while controlling risk. Selling rules and profit-taking strategies are what turn a good trade into a winning one. Mark Minervini uses a structured approach to selling. He sets predefined exit points based on price targets, chart patterns, and technical signals. He often scales out of positions, selling portions as the stock moves higher. This allows him to lock in profits while keeping a stake in a stock that may continue to rise. Minervini also uses trailing stops, which follow the stock's upward movement. These stops protect gains by automatically exiting a position if the stock reverses, ensuring that winners do not turn into losers. He emphasizes that discipline in selling is just as important as discipline in buying. David Ryan focuses on recognizing signs of weakening momentum. He observes changes in volume, price action, and sector trends to determine when a stock is losing strength. Ryan stresses that traders should not be greedy. Even a strong leader can stall or reverse, and holding too long can erode profits. He combines technical signals with market context to decide when to take profits. Like Minervini, He often scales out gradually, reducing risk while still participating in potential upside. The goal is to maximize gains without letting fear or greed interfere with decisions. Dan Zanger approaches selling with precision and preparation. He sets clear exit rules based on chart patterns and key support levels. Zanger uses stop losses to protect profits and prevent emotional decisions. He also recognizes the psychological importance of taking gains. Exiting too early may leave potential upside on the table, but waiting too long can turn a winning trade into a losing one. Zanger balances these considerations by planning exits in advance and sticking to his rules. This disciplined approach ensures that every profit is protected and no trade is left to chance. All three traders emphasize that selling is not an afterthought. It is a critical part of the trading plan. Many traders focus on entries and ignore exits, which often leads to unnecessary losses. Momentum trading is about riding strong trends, but knowing when to step aside preserves gains and keeps capital available for future opportunities. Another key principle is adapting to changing conditions. Markets are dynamic, and a stock's momentum can fade quickly. Selling rules must be flexible enough to respond to shifts in trend while remaining grounded in objective criteria. Using trailing stops, scaling out, and observing technical signals allows traders to navigate these changes without letting emotions dictate action. Profit taking is also closely tied to risk management. By locking in gains, traders reduce the impact of losses on overall performance. Minervini, Ryan, and Zanger all stress that protecting profits is as important as limiting losses. A disciplined approach to selling transforms a series of good trades into a sustainable, long-term winning strategy. With clear selling rules and profit-taking strategies in place, traders are better equipped to handle losses when they occur. Understanding that losses are part of the process and knowing how to manage them is critical for staying consistent in the market. Chapter 10. Handling losses and drawdowns. No trader wins every trade. Losses are inevitable, even for the most skilled momentum masters. What separates champions like Mark Minervini, David Ryan, and Dan Zanger from ordinary traders is not the absence of losses, but how they respond to them. Learning to handle losses and drawdowns is essential for long-term success. Mark Minervini treats losses as lessons, not failures. Every losing trade is an opportunity to analyze what went wrong and refine his process. He keeps meticulous trade records, noting entry points, stop placements, market conditions, and emotional responses. By reviewing this data, he identifies patterns in his mistakes and adjusts his strategy accordingly. Minervini emphasizes that controlling risk limits the emotional impact of losses. If a trade is properly sized and stops are respected, even a loss does not threaten his capital or confidence. David Ryan focuses on maintaining perspective during drawdowns. He recognizes that the market is unpredictable and that even the best setups can fail. Ryan manages losses by keeping them small relative to the overall portfolio. He also maintains a disciplined routine, which prevents emotional decision-making when trades go against him. By sticking to predefined rules, Ryan avoids the trap of revenge trading, trying to make back losses impulsively, which often leads to larger setbacks. Drawdowns are treated as a natural part of the trading journey, not a personal failure. Dan Zanger approaches losses with preparation and mental resilience. He expects setbacks and plans for them in advance. His stop losses are not arbitrary. They are calculated based on technical levels and pattern analysis. When a trade fails, Zanger exits without hesitation, preserving both capital and emotional stability. He views drawdowns as temporary setbacks that do not define his long-term success. Zanger's ability to accept losses calmly allows him to remain focused on opportunities that meet his criteria, rather than dwelling on mistakes. All three traders share common strategies for handling losses. First, they control risk through strict stop-loss rules and position sizing. Second, they keep detailed records to learn from every trade. Third, they maintain a disciplined mindset, preventing fear, frustration, or revenge from influencing future decisions. Losses are inevitable, but they are also manageable when approached with the right systems and mindset. Psychology plays a critical role in surviving drawdowns. Many traders panic, abandon strategies, or make impulsive trades after a loss. Momentum masters understand that emotion is the enemy of consistency. They separate their identity from their trades, viewing losses objectively rather than personally. This mental clarity allows them to remain patient, wait for high probability setups, and execute with confidence. Another important principle is perspective. A single loss, or even a streak of losses, does not indicate failure. What matters is the overall process and consistency over time. Minervini, Ryan, and Zanger focus on maintaining an edge, following rules, and letting probabilities play out. They understand that surviving drawdowns is more important than trying to be perfect. Long-term success comes from preserving capital, learning from mistakes, and sticking to proven strategies. By mastering losses and drawdowns, traders gain resilience and confidence. They learn that setbacks are temporary, risks are manageable, and every loss contains a lesson. Handling losses effectively ensures that traders can stay in the game long enough to benefit from their momentum edge and disciplined strategies. With the foundation of stock selection, chart reading, timing, risk management, and loss handling in place, the next essential element of trading success is psychology, the mindset that sustains discipline, patience, and confidence through every trade. Part 3. The psychology of a champion trader. Trading is not just a technical skill, it is a mental discipline. You can have the best strategy, perfect timing, and flawless risk management, yet without the right mindset, consistent success is impossible. Part 3 explores the inner world of Mark Minervini, David Ryan, and Dan Zanger, how they think, feel, and maintain focus amid the volatility of the market. This section delves into the psychology that separates champions from the rest. It examines how top traders cultivate discipline, patience, and confidence. It reveals how they handle fear, control emotions, and stay calm under pressure. Trading is a battlefield of the mind, where impulsive decisions and emotional reactions can destroy years of careful preparation. By understanding the mental habits of successful momentum traders, we gain insight into how to remain resilient, rational, and consistent. In the coming chapters, we will explore mindset, discipline, patience, emotional control, and common mistakes to avoid. These principles are not abstract. They are actionable strategies that help traders maintain focus and clarity, even in the most challenging markets. As we move forward, we begin with the foundation of all psychological success in trading. Chapter 11. Mindset, Discipline, and Confidence. The foundation of every successful trader is mindset. Mark Minervini, David Ryan, and Dan Zanger all agree that technical skills, strategies, and risk management are meaningless without the right mental approach. A champion trader develops a mindset that balances discipline, confidence, and patience, the three pillars of psychological success in the market. Mark Minervini emphasizes discipline above all. He follows strict rules for entry, risk, and exit, never deviating based on emotion or speculation. Discipline is not rigid obedience. It is consistent application of a tested plan. Minervini notes that traders often fail because they overtrade, chase losses, or ignore their rules in moments of excitement. Maintaining discipline ensures that every decision is deliberate, calculated, and aligned with probability, not impulse. Confidence is equally important. Minervini, Ryan, and Zanger stress that confidence is earned through preparation and experience, not assumed. Traders gain confidence by thoroughly studying charts, understanding patterns, and practicing entries and exits. Confidence allows them to act decisively when high-probability setups appear, avoiding hesitation that can erode gains. However, overconfidence is dangerous. Momentum masters remain humble, respecting the market's unpredictability while trusting their method. David Ryan highlights the mental challenge of staying focused during both winning and losing streaks. Discipline helps him stick to his strategy even when trades fail. Confidence ensures he does not second-guess setups when the market temporarily moves against him. A strong mindset combines these traits, creating resilience and consistency. Ryan also notes that confidence should be flexible. Traders must adapt when patterns fail, or market conditions change, without abandoning their overall approach. Dan Zanger stresses that mindset is also about preparation and visualization. He memorized patterns, studied price action, and mentally rehearsed trades before committing capital. This preparation builds confidence and reduces fear, allowing him to execute with precision. Zanger understands that emotional control is a skill, strengthened through repetition and experience. A calm, focused mind sees opportunities clearly and responds appropriately rather than reacting impulsively. All three traders agree that mindset is cultivated over time. It develops through experience, reflection, and practice. Losing trades. Test discipline and confidence, and each setback provides lessons to reinforce the mental foundation. Traders who lack the right mindset often let fear, greed, or frustration dictate their actions, leading to inconsistent results. Champions understand that mental mastery is as important as technical mastery. Discipline and confidence are also intertwined. Discipline protects against impulsive mistakes, while confidence empowers decisive action when conditions align. Together, they create a mental framework that allows traders to navigate uncertainty, manage risk effectively, and exploit momentum without hesitation. By mastering mindset, discipline, and confidence, a trader can remain composed in volatile markets, stick to their rules, and execute strategies with precision. These qualities form the bedrock of long-term success. The next challenge for every momentum trader is patience, the ability to wait for the perfect setup and resist the temptation to act prematurely. Chapter 12. Patience and the importance of waiting for the setup. One of the most difficult lessons for traders to learn is patience. Mark Minervini, David Ryan, and Dan Zanger all stress that the market rewards those who wait for the perfect setup rather than forcing trades. Momentum trading is not about constant action. It is about precision and timing. Entering too early or chasing a stock can lead to losses, while waiting for the right conditions increases the probability of success. Mark Minervini teaches that patience is active, not passive. It does not mean doing nothing. It means preparing, observing, and being ready to act when the setup appears. He spends hours analyzing charts, tracking leaders, and monitoring market conditions. By waiting for a defined pattern to complete, whether it is a base formation, breakout, or consolidation, he ensures that each trade has a high probability of success. Minervini emphasizes that traders who lack patience often enter impulsively, ignore their rules, and ultimately compromise risk management. David Ryan approaches patience through discipline and preparation. He notes that the strongest stocks do not need to be chased. They reveal themselves through relative strength and breakout patterns. Ryan patiently observes volume, sector performance, and institutional activity, waiting for confirmation before committing capital. This approach prevents emotional trading, which is a common reason for losses among inexperienced traders. Patience also allows Ryan to conserve capital for the highest probability opportunities rather than spreading resources too thin across weak setups. Dan Zanger reinforces the importance of waiting for the right pattern. His strategy is pattern-driven, and rushing into trades often results in poor entries and unnecessary risk. Zanger studies price action and volume carefully, identifying setups that meet his strict criteria. He waits until the technical conditions are met before acting, demonstrating that patience is not about inactivity, but about timing and precision. By adhering to this discipline, Zanger ensures that every trade has a favorable risk-reward ratio and aligns with his momentum edge. All three traders emphasize that patience is also a psychological skill. The temptation to act quickly, fueled by fear of missing out, is strong. However, successful momentum trading requires resisting this urge. The market provides countless opportunities, and waiting for the setup that aligns with your strategy is far more effective than jumping at every move. Patience allows traders to maintain clarity, reduce mistakes, and execute trades with confidence. Another element of patience is learning to sit on the sidelines. Many new traders feel pressure to be constantly active, but inactivity is often the best decision. By observing without acting, traders gather information, analyze patterns, and refine their watch lists. This preparation ensures that when a high probability setup appears, they can act decisively without hesitation. Patience also ties directly into risk management and confidence. Waiting for the right setup reduces exposure to unnecessary risk, reinforces discipline, and strengthens trust in one's strategy. A trader who masters patience avoids emotional mistakes, respects market dynamics, and improves the overall quality of every trade. In momentum trading, time is an ally, not an enemy. Waiting for the optimal moment ensures that the odds remain in your favor, increasing the likelihood of profitable outcomes. With patience established as a critical skill, the next chapter explores emotional control, how top traders manage fear, greed, and other emotions that can sabotage even the best strategies. Chapter 13. Dealing with emotions and fear. Even the best strategies can fail if a trader allows emotions to dictate decisions. Mark Minervini, David Ryan, and Dan Zanger all emphasize that controlling emotions, especially fear and greed, is one of the most important aspects of trading. Momentum trading requires acting decisively when opportunities arise and exiting when conditions change. Without emotional control, hesitation or impulsive actions can erase gains and increase losses. Mark Minervini teaches that fear is often the result of uncertainty. Traders fear losing money, missing out on opportunities, or making mistakes. Minervini combats fear by relying on rules and preparation. Each trade has predefined entry and exit points, stop-loss levels, and position sizes. When a trade is executed according to plan, there is no need to panic. By trusting the strategy, Minervini reduces emotional reactions and maintains clarity, even when the market moves rapidly. Fear transforms into focus when rules are followed. David Ryan emphasizes the importance of separating decisions from emotions. He notes that greed can be as dangerous as fear, leading traders to hold positions too long or take excessive risk. Ryan combats emotional decision-making by sticking to his strategy and predetermined criteria. He also keeps a trading journal, reflecting on emotional responses during trades. This self-awareness helps him recognize patterns of fear or overconfidence and adjust his mindset accordingly. Emotional control is not about suppressing feelings. It is about acting objectively and consistently. Dan Zanger approaches emotions with preparation and repetition. By memorizing patterns, analyzing charts, and pre-planning trades, he reduces the uncertainty that triggers fear. When a trade meets his criteria, he acts decisively, knowing that risk has been calculated and rules are in place. Zanger also emphasizes that losses, while inevitable, are not personal failures. Accepting this mentally prevents emotional spirals and allows him to maintain focus on the next opportunity. All three traders agree that emotions are amplified during volatility. Price swings, news events, or unexpected market behavior can create anxiety. Momentum masters anticipate these moments and remain detached from outcomes. They focus on executing their plan rather than reacting impulsively. Emotional control becomes easier when preparation, discipline, and confidence are in place. Another principle is objectivity. Traders must see the market as it is, not as they wish it to be. By interpreting price action and patterns without bias, they reduce the impact of fear and greed. Emotions often distort perception, causing traders to misread trends, exit prematurely, or overextend risk. Objective observation allows for rational decisions aligned with probability and strategy. Mindset, patience, and emotional control are interconnected. Fear and impulsivity are reduced when a trader has confidence in a well-defined strategy, is patient for the right setup, and understands risk management. These qualities allow momentum traders to stay disciplined, avoid common mistakes, and maintain consistency in both winning and losing periods. Finally, momentum trading is a test of self-mastery. Those who can control emotions, manage fear, and remain patient under pressure gain a significant edge. Psychological resilience allows traders to act decisively, maintain focus, and follow their strategies without letting short-term outcomes derail long-term success. The next chapter addresses common mistakes traders make and how to avoid them. reinforcing lessons in mindset, discipline, patience, and emotional control. Chapter 14. Common Mistakes Traders Make. Even experienced traders can fall into traps that undermine their success. Mark Minervini, David Ryan, and Dan Zanger all emphasize that avoiding common mistakes is as important as executing a winning strategy. Many of these mistakes are psychological, rooted in impatience, fear, greed, or overconfidence. Recognizing them helps traders stay disciplined, consistent, and aligned with high-probability setups. One frequent mistake is overtrading. New traders often feel pressure to be constantly active, buying every stock that moves or chasing every trend. Minervini warns that overtrading leads to poor entries, higher risk exposure, and emotional fatigue. Momentum trading is about precision, not quantity. Waiting for the right setups, even if it means sitting on the sidelines for days, is far more profitable than forcing trades out of boredom or impatience. Another common mistake is ignoring risk management. Traders sometimes enter positions without defining stop losses, position sizes, or exit strategies. Ryan notes that this exposes capital to unnecessary danger and allows emotions to dictate decisions. Even a strong setup can fail, and without protective measures, losses can escalate quickly. Successful traders always know their maximum risk before entering a trade. Overconfidence is another pitfall. Zanger emphasizes that even a high-probability trade can fail. Traders who assume they are always right may ignore signals, hold positions too long, or over-leverage their accounts. Confidence must be balanced with humility and constant evaluation of market conditions. Recognizing that mistakes are inevitable prevents overconfidence from turning into costly errors. Chasing losses is another psychological trap. Many traders, after experiencing a loss, attempt to recover immediately through impulsive trades. This revenge trading often compounds losses and disrupts discipline. Minervini, Ryan, and Zanger all stress the importance of stepping back, reviewing what went wrong, and returning to the market only when high-probability setups reappear. Failing to follow a plan is also common. Traders may start with rules for entry, risk, and exit, but let emotions, tips, or rumors alter their decisions. Momentum masters stick to their plan rigorously. Deviating from the strategy increases risk and reduces the likelihood of consistent results. A predefined plan removes guesswork, reduces emotional influence, and enhances confidence. Another frequent error is ignoring the bigger market context. Traders sometimes focus only on individual stocks without considering sector trends, relative strength, or overall market conditions. Ryan emphasizes that even the strongest stock can fail if the broader market or sector is weak. Understanding the context ensures that trades align with prevailing momentum forces, increasing the probability of success. Finally, impatience and lack of observation can sabotage trades. Entering too early, exiting too late, or misreading charts often leads to losses. Zanger notes that careful observation, waiting for confirmation, and executing only when conditions are favorable are essential to maintaining an edge. Avoiding these mistakes requires discipline, self-awareness, and adherence to proven principles. Mindset, patience, preparation, and emotional control all work together to reduce errors and enhance consistency. Momentum traders who understand and mitigate these common pitfalls are far more likely to achieve long-term success. With common mistakes identified and strategies to avoid them in place, the next chapter focuses on maintaining focus and mental clarity. Chapter 15. How to Stay in the Zone. Momentum trading is not only about skill, strategy, and discipline, it is also about mental alignment. Mark Minervini, David Ryan, and Dan Zanger all emphasize that staying in the zone is a state of focus where decisions become fluid, emotions are controlled, and execution is precise. This mental state allows traders to act decisively on high-probability setups without hesitation or distraction. Mark Minervini describes the zone as a combination of preparation, awareness, and confidence. When he is fully prepared, having analyzed charts, tracked watch lists, and identified setups, he can focus solely on observing the market. This concentration allows him to act quickly when conditions are right, without second guessing. For Minervini, discipline and routine are crucial for entering the zone consistently. Following a structured process reduces mental clutter and frees cognitive resources for high-quality decision-making. David Ryan adds that staying in the zone requires emotional balance. Fear, greed, or excitement can pull a trader out of focus, leading to mistakes or impulsive actions. Ryan manages this by maintaining perspective and separating self-worth from trade outcomes. Understanding that losses are part of the process and gains are rewards for following the rules keeps the mind calm. When emotions are neutralized, the trader can observe patterns objectively and respond rationally rather than reactively. Dan Zanger emphasizes the importance of visualization and rehearsal. He mentally prepares for trades by anticipating patterns, breakouts, and potential reactions. This preparation primes the brain to recognize setups immediately and respond without hesitation. Zanger also stresses that staying in the zone requires physical and mental readiness. Adequate rest, clear focus, and elimination of distractions are essential. A tired or distracted mind is prone to errors, even when the strategy is sound. Another key to staying in the zone is routine. All three traders maintain consistent habits, from pre-market analysis to post-trade review. These routines create familiarity, reduce uncertainty, and allow the brain to focus on critical decisions rather than trivial distractions. Momentum trading is a game of probabilities, and having a consistent process ensures that decisions are aligned with high-probability setups. Mindset, discipline, and patience also play a role in maintaining focus. A trader who trusts their strategy, waits for the right setup, and respects risk management can enter the zone with confidence. They do not chase trades or act impulsively. They understand that the market provides countless opportunities, and the key is to execute selectively and precisely. Visualization, emotional control, and structured routines all converge to create the zone. It is not a mystical state, but a product of preparation, self-mastery, and disciplined execution. When a trader is in the zone, actions are effortless yet deliberate, observation is acute, and decisions are aligned with probability. Staying in the zone is not just about individual trades, it affects the overall trading journey. It allows for consistency, reduces mental fatigue, and enhances the ability to recognize and exploit opportunities over time. Momentum masters use this mental state to execute trades with precision while navigating the inherent uncertainties of the market. With psychological mastery in place, including mindset, patience, emotional control, and focus, traders are prepared to tackle the final stage of mastery, translating experience and adaptability into consistent long-term success. Part 4. The Wisdom of Experience. After mastering strategy, risk management, and psychology, the final step in becoming a momentum master is experience. Part 4 explores how Mark Minervini, David Ryan, and Dan Zanger translate years of trading into consistent, disciplined, and adaptive decision-making. Experience is not just about time spent in the market. It is about learning from successes, failures, and the ever-changing environment. This section delves into the lessons that only come from repeated practice: how to read market conditions, refine routines, trust intuition, and adapt strategies to different circumstances. It emphasizes that momentum trading is a continuous journey where learning never stops. The wisdom gained from experience allows traders to navigate uncertainty, anticipate trends, and execute with confidence even when conditions are volatile. In the coming chapters, we will explore market adaptability, trading routines, the role of intuition, advice for aspiring traders, and final insights on becoming a true momentum master. As we move forward, we begin with understanding how the market environment and adaptability shape a trader's long-term success. Chapter 16. Market Environment and Adaptability. Markets are constantly evolving, and what works in one environment may fail in another. Mark Minervini, David Ryan, and Dan Zanger all stress the importance of understanding the market context and adapting strategies accordingly. Experience teaches that flexibility, observation, and timely adjustments are key to sustaining success in momentum trading. Mark Minervini emphasizes that trends, sector leadership, and market cycles are critical to identify before committing capital. A strong stock in a weak sector, or during a declining market, may struggle despite its technical strength. Minervini studies broader market signals, including indices, sector relative strength, and macroeconomic indicators, to ensure that his trades are aligned with prevailing momentum forces. He adapts his approach depending on whether the market is in a strong uptrend, a sideways range, or a correction. Understanding the environment allows him to adjust position size, timing, and trade frequency for maximum effectiveness. David Ryan highlights the role of observation in adapting to changing market conditions. He monitors volume, price behavior, and sector rotation to anticipate shifts in momentum. When market dynamics change, successful traders recognize early warning signs and adjust their strategies rather than stubbornly sticking to old patterns. Adaptability also involves being selective about trades. Ryan notes that fewer trades executed under favorable conditions often outperform frequent trades made during unfavorable environments. Experience teaches that patience and selective action are as important as technical skill. Dan Zanger stresses that adaptability comes from both preparation and intuition. He studies historical patterns, monitors intraday movements, and compares setups across timeframes to identify the best opportunities. When conditions shift, Zanger is prepared to scale positions, tighten stops, or exit early to protect capital. He understands that rigid strategies fail in dynamic markets, and learning to read subtle cues from price action is essential. Over time, repeated exposure to different environments builds the ability to respond fluidly while maintaining discipline. All three traders share key principles for adapting to market environments. First, context matters. No stock exists in isolation, and sector and market strength influence outcomes. Second, observation and attention to detail allow traders to identify changes early. Third, flexibility and willingness to adjust tactics separate long-term winners from those who fail. Experience provides the insight needed to balance discipline with adaptability. Another lesson from experience is managing expectations. Markets are unpredictable, and not every trade will succeed. Momentum masters learn to accept this and focus on probability rather than certainty. Adaptability is not about being reactive to every small movement. It is about recognizing meaningful signals, adjusting strategy, and acting decisively when the odds are favorable. Experience also teaches resilience. Market reversals, unexpected news, and failed trades are inevitable. Traders who can adapt without abandoning their principles survive and thrive over the long term. By combining careful observation, market context, and flexible execution, momentum traders maintain an edge even in challenging conditions. With the ability to read and adapt to the market environment, the next step is creating routines and preparation strategies that support consistent performance and sharpen focus. Chapter 17: Trading Routine and Preparation. Success in momentum trading is not accidental. It is the result of disciplined routines and careful preparation. Mark Minervini, David Ryan, and Dan Zanger all emphasize that a structured approach to each trading day creates consistency, reduces errors, and keeps focus sharp. Experience teaches that preparation is as important as execution because it primes the mind to recognize high-probability setups when they appear. Mark Minervini begins his day with pre-market analysis. He reviews watch lists, scans for leaders, and evaluates recent price action. By identifying potential setups in advance, he reduces decision-making under pressure and avoids impulsive trades. His routine includes reviewing key support and resistance levels, monitoring sector performance, and noting stocks that meet his strict technical criteria. This preparation allows him to act decisively when the market opens, staying ahead of less organized traders. David Ryan also stresses the importance of consistent routines. He allocates time for chart study, monitoring institutional activity, and reviewing news that could impact sectors or stocks he follows. Ryan notes that discipline in routine minimizes emotional reactions during trading hours. By establishing a predictable workflow, traders free cognitive energy for critical decisions, rather than being distracted by last-minute analysis or unplanned observations. A structured routine builds confidence and ensures that every action is deliberate and informed. Dan Zanger approaches routine as a combination of preparation and pattern recognition. He studies historical charts, tracks price and volume behavior, and memorizes setups that meet his criteria. This mental library allows him to quickly identify patterns in real time. Zanger also integrates review sessions into his routine, reflecting on past trades to reinforce lessons and refine techniques. Preparation reduces uncertainty and positions the trader to respond to opportunities with speed and accuracy. All three traders agree that preparation extends beyond the charts. Physical readiness, emotional balance, and environmental setup are equally important. Adequate rest, clear workspace, and minimizing distractions allow the mind to remain focused. Momentum trading is fast-paced, and mental clarity is required to interpret signals and execute precise actions. Experience teaches that the trader who is organized and prepared consistently outperforms those who rely solely on intuition or reactive decision-making. Another key principle is the creation of checklists. Minervini, Ryan, and Zanger all use systematic checklists for entries, exits, and risk assessment. These checklists act as safeguards, ensuring that critical steps are not overlooked in the heat of trading. They provide structure, maintain discipline, and reinforce confidence. A well-prepared trader follows these routines instinctively, allowing execution to become seamless. Routine and preparation also enhance adaptability. By consistently monitoring market conditions and evaluating setups, traders are better equipped to respond to changing environments. Patterns are recognized faster, decisions are made more confidently, and mistakes caused by oversight or haste are minimized. Over time, disciplined routines become habits that support mental focus, efficiency, and consistency. With routines and preparation firmly established, the next chapter explores how intuition and experience complement technical skills to make a trader truly adept at identifying high-probability opportunities. Chapter 18. The Role of Intuition and Experience. Experience in the markets teaches lessons that no textbook or strategy alone can provide. Mark Minervini, David Ryan, and Dan Zanger all agree that intuition, honed through repeated practice and observation, plays a crucial role in momentum trading. This intuitive sense allows traders to recognize opportunities, anticipate market behavior, and act decisively when technical conditions align. Mark Minervini describes intuition as pattern recognition, developed over years of observing price action and market behavior. While technical rules provide a framework, experience allows him to sense when a stock is ready to move even before formal signals are confirmed. This intuitive edge is grounded in careful study, disciplined routines, and repeated exposure to similar setups. Minervini emphasizes that intuition is not guessing. It is the subconscious integration of knowledge, data, and historical patterns. David Ryan also highlights the value of experience in developing intuition. Having witnessed countless breakouts, consolidations, and reversals, Ryan can often anticipate potential moves based on subtle clues in price and volume. Experience teaches him what to ignore and what to focus on, filtering out noise in the market. Intuition complements analysis, providing confidence to act quickly when high-probability trades present themselves. Ryan notes that this ability develops gradually and requires disciplined reflection on both successful and unsuccessful trades. Dan Zanger stresses that intuition is sharpened by repetition and attention to detail. Memorizing chart patterns, studying volume trends, and observing sector performance allows him to recognize setups instinctively. When a stock meets his criteria, Zanger can act decisively, relying on both technical confirmation and intuitive judgment. Experience enables him to discern quality trades from those that appear promising but carry hidden risk. This skill cannot be rushed. It develops through consistent practice and active engagement with the markets. All three traders agree that intuition is most effective when combined with disciplined strategy and risk management. Acting solely on gut feeling without preparation is dangerous. But when intuition is informed by experience, rules, and observation, it becomes a powerful tool. Experienced traders use intuition to anticipate moves, position themselves advantageously, and manage trades with confidence. Another lesson from experience is the ability to adapt. Market conditions change, patterns evolve, and what worked in the past may not always succeed. Intuition allows traders to sense these shifts early and adjust their approach accordingly. It helps them recognize when a setup is no longer valid, when momentum is fading, or when external factors could influence price action. Adaptability, guided by intuitive insight, separates seasoned traders from those who rigidly follow rules without context. Finally, intuition and experience provide a sense of timing that is impossible to achieve with theory alone. Understanding subtle price action, volume surges, and market psychology allows traders to act decisively, enter at optimal points, and exit strategically. It is the bridge between knowledge and execution, the skill that turns preparation into profitable action. With intuition informed by experience, traders are ready to share their advice and insights for those aspiring to follow in their footsteps. The next chapter consolidates lessons, offering guidance for emerging traders seeking to build their own momentum mastery. Chapter 19: Advice for Aspiring Traders. For those who wish to follow the path of momentum trading, Mark Minervini, David Ryan, and Dan Zanger offer guidance rooted in years of experience. Their advice combines technical principles, psychological mastery, and lessons learned from successes and failures. Aspiring traders can accelerate their learning by adopting these insights and applying them consistently. Mark Minervini emphasizes the importance of education and preparation. He advises new traders to study charts daily, understand price action, and analyze historical patterns. Learning the language of the market provides context for decision-making and builds confidence. Minervini also stresses discipline. Sticking to rules for entry, risk, and exit is far more important than chasing profits. He encourages traders to define their strategy clearly, maintain a watch list of strong candidates, and wait patiently for setups that meet their criteria. David Ryan focuses on mindset and risk management. He advises beginners to respect the markets, accept that losses are part of the process, and avoid emotional trading. Ryan recommends starting with small positions, controlling risk, and keeping meticulous records to review each trade. Learning from mistakes without letting them impact confidence is critical. He also highlights the importance of observation and patience. Understanding sector trends, relative strength, and market context helps traders identify high-probability opportunities. Dan Zanger underscores the value of repetition, focus, and pattern recognition. He recommends that aspiring traders spend time studying historical setups, memorizing patterns, and mentally rehearsing trades. Zanger notes that experience cannot be rushed. Intuition develops through exposure, reflection, and disciplined practice. He also emphasizes the importance of routines and preparation, which create consistency and mental clarity. Following structured habits reduces errors and prepares traders to act decisively when opportunities arise. All three traders stress the importance of emotional control. Fear, greed, and impatience are the primary obstacles for new traders. Learning to stay calm, detached, and objective is essential. They advise developing routines that include pre-market analysis, post-trade review, and reflection on emotional responses. A trader who masters their psychology can make rational decisions even under pressure. Another piece of advice is continuous learning. Markets evolve, sectors rotate, and strategies may need adjustment. Aspiring traders should read, observe, and practice constantly. They must adapt to changing conditions without abandoning principles of risk management and discipline. Mentorship, studying successful traders, and participating in trading communities can also accelerate growth, but practical experience remains irreplaceable. Consistency is a recurring theme. Rather than seeking immediate wealth, traders should focus on executing their strategy repeatedly, protecting capital, and learning from each trade. Momentum trading rewards patience, preparation, and disciplined execution over impulsive decisions and emotional reactions. Minervini, Ryan, and Zanger all agree that steady progress, guided by rules and reinforced by experience, is the key to long-term success. Finally, aspiring traders should develop humility and resilience. Every trader experiences setbacks, but the ability to learn from losses, remain adaptable, and persist through challenges defines success. By combining education, preparation, discipline, emotional control, and continuous practice, emerging traders can build a foundation for sustainable momentum mastery. With guidance for aspiring traders established, the journey culminates in final reflections. The ultimate lessons that define a true momentum master. Chapter 20. Final Thoughts. Becoming a Momentum Master. Becoming a momentum master is the culmination of knowledge, experience, discipline, and psychological resilience. Mark Minervini, David Ryan, and Dan Zanger illustrate that success in trading is not about shortcuts or luck. It is about developing a systematic approach, mastering the mental game, and learning from every trade. The lessons shared throughout this book provide a roadmap, but mastery comes from application, practice, and continuous refinement. Mark Minervini emphasizes that momentum trading requires a balance of preparation and execution. The trader must study charts, understand patterns, and identify high-probability setups while maintaining strict discipline and risk management. Patience is crucial. Waiting for the right opportunities, rather than forcing trades, ensures that capital is deployed where the odds are in favor. Minervini stresses that consistency is more important than occasional big wins. Long-term results are built by following proven processes reliably over time. David Ryan reinforces the importance of mindset. Confidence, emotional control, and objectivity separate successful traders from those who falter. Fear, greed, and impatience are common obstacles, but with discipline and self-awareness, they can be managed. Ryan highlights that resilience is essential. Losses and drawdowns are part of the journey, and learning to navigate them without abandoning rules is critical. Momentum masters treat mistakes as lessons, not failures, and continually refine their approach based on experience. Dan Zanger focuses on the role of intuition and experience. Years of observing price action, memorizing patterns, and reflecting on outcomes develop a sixth sense that allows traders to anticipate moves and respond decisively. Intuition does not replace rules but complements them, providing an edge when technical conditions align. Zanger emphasizes that repetition, preparation, and focus create the mental clarity necessary to recognize high-probability setups quickly and act with precision. All three traders agree that adaptability is vital. Markets evolve, sectors rotate, and conditions change. A momentum master is flexible, able to adjust strategies while maintaining core principles of risk management, discipline, and observation. Experience teaches when to scale positions, when to exit early, and when to sit on the sidelines. This adaptability, combined with systematic routines, preparation, and psychological mastery, forms the foundation of long-term success. Momentum mastery is not a destination, but a journey. Each trade, whether winning or losing, contributes to the trader's growth. Success requires continuous learning, reflection, and improvement. Maintaining structured routines, respecting risk, mastering emotions, and acting with patience ensures that a trader remains positioned to exploit opportunities consistently. Finally, becoming a momentum master is about integration. It requires combining technical skill, psychological strength, experience, intuition, and adaptability into a seamless approach. Mastery is achieved when these elements work together effortlessly, allowing the trader to execute strategies decisively, manage risk effectively, and maintain focus under pressure. The path of a momentum master is challenging, but it is also rewarding. Those who commit to disciplined practice, continuous learning, and mental mastery develop the skills, resilience, and insight necessary to navigate the complexities of the market. By following the principles outlined by Minervini, Ryan, and Zanger, aspiring traders can transform knowledge into consistent, long-term success, ultimately becoming true momentum masters. This concludes the journey through Momentum Masters, where strategy meets psychology, experience shapes intuition, and discipline transforms potential into results.